What's up, everybody? This is Leaf with Adaptable Wealth, and if you've seen all my videos on residential real estate, you know the 5 ways that you can make money investing in properties, you know whether or not residential real estate's an effective inflation hedge, and you know whether it's a good portfolio diversifier or not. But what about the risks? Well, that's exactly what we're going to discuss in today's video. The overwhelming risk to an investment in real estate right now is the bubble in the housing market. In my opinion, there's no two ways about it. We're in another housing bubble, and the evidence is overwhelming. All you have to do is look at this chart from Case-Shiller that we discussed earlier. It shows the inflation-adjusted home prices at the national level. We're currently at an index level of 213 versus an index level of 196 at the peak of the 2005-2006, right before the bursting of that bubble. The overwhelming consensus of the cause of the current bubble is lower interest rate, which makes the monthly payment lower and therefore more affordable for the median home buyer, and the elephant in the room, which is historically low supply. I'm not here to make an argument about whether the housing bubble is going to pop now or at some point in the future. It's quite easy to see that we will eventually come back to the green line. We always do, and we will again at some point. Since 1968, the housing market on a national level, as measured by this inflation-adjusted Case-Shiller index, has retraced to this green trend line 5 times, and it will once again at some point. Instead, I wanted to focus on establishing the fact that we are in a housing bubble once again, and that this is the primary risk to a real estate investment at this point in time. There are 7 primary indicators of irrational exuberance in the real estate market. The first is housing prices adjusted for inflation and interest rates. As we just discussed, the national Case-Shiller Home Price Index is higher than it was just before the Great Financial Crisis. And it's not just a few markets. Out of the 20 markets that the Case-Shiller Index tracks, about half of them are at or above the pre-Great Financial Crisis levels. And all but 2 are the most expensive since 1990. The next indicator are prices versus income. At approximately 6, the median price to income ratio is higher than it's been going back to 1984. Next is the mortgage payment as a percentage of median household income. A mortgage payment on the median priced home as a percentage of median household income is the highest since 1990. This shows that currently the payment on the median priced home consumes 36% of median household income, higher than the peak of the GFC. The red line shows the actual mortgage payment as a percentage of median income based on interest rates at that time. It was 45% in 1984 and possibly the highest ever. This is because of the sky-high interest rates at the time, which is the blue line. And this doesn't account for income taxes, property taxes, homeowners insurance, mortgage insurance if you put less than 20% down, utilities, or any other costs of owning a home. If you were to add those in, we'd likely be looking at 50% or more of the median household income going towards housing costs. The third indication that real estate prices have diverged from economic fundamentals is the price-to-rent ratio. The price-to-rent ratio is exactly what it says. You take the median price of a house and divide it by the median rent. This is important because it can give us a gauge of emotion in the housing market. You generally have 2 choices when deciding where to live. You can either buy or rent, and the 2 act as counterbalancing forces against one another. When housing prices diverge from rents and people make the decisions to pay $500, $600, $700 more per month to own a home, it can be a sign that people are basing their decisions on emotions rather than logic and financial planning. Then there's FOMO. Fear of missing out is the existence of unusually high demand due to expectations of large future gains. In real estate, we look at 4 primary metrics to gauge buyer demand and sentiment. The first is the sales to list ratio. As you can see, sellers have generally had to reduce their list price between 2 and 4% to sell their property since 2012. Starting in 2021, sellers have been able to sell their homes for more than their list price, reaching a max of approximately 103% as of May 2022. In addition to the high sales to list ratio, the percent of homes that sold above asking is a whopping 60%. Over the 2012 to 2020 period, that percentage sat at about 25%. That's a doubling in the percent of homes that sell for more than asking, signaling insane demand and FOMO. Next, we have the percent of price drops. Over 2015 to 2020, the average percent of homes with price reduction sat at about 12 to 13%. Since the start of 2021, that rate decreased to about 10%, further supporting the notion that sellers had control of the market since 2021. Next, we have days on market. This trend is significantly lower days on market is obvious since 2012, where it went from 97 days in 2012 to 16 as of May 2022, an 84% decline, a sure sign of excess demand. Couple that with an explosion in the percent of homes entering pending sale status within 2 weeks of listing, and it's not hard to see the presence of FOMO in the housing market through Q1 2022. Next, we have possibly the most important driver of today's insanely high real estate prices across the country: unusually low supply. Low supply of anything, provided there is a demand for it, will push the price up, and the price will explode if demand is high while supply is low. We've already established the presence of excess demand for residential real estate. Couple that with extremely low inventory, and no wonder why we only have 1 to 2 months supply of homes right now, which is a historically low rate. In the years leading up to the GFC, which nobody will argue that we were not in a bubble at the time, we were running at about 4 months supply. Now I can hear some of you screaming at your computer, "But Leaf, the low supply will put a floor under real estate prices." That is true, for now. If you have done any meaningful research into the behavior of asset prices or markets, you'll see that there is a long-run trend, and when prices get significantly higher or lower than that trend, there is always a reversion to and through the long-run trend. At some point, demand will cool, which we are already starting to see due to higher interest rates, and we will also see inventory increase, whether it be due to more building or existing homes being placed on the market. After that, we have investors' market share, or the percentage of total homes purchased by investors. According to Redfin, investors bought a record 20% of all sales in Q1 2022. The theory is that the proportion of investors is important because they're more likely to be the first to unload their properties and stop buying more if the market starts to fall. This is particularly true for flippers because they get clobbered if prices are falling. Rising or flat prices are required for their business model to work. And publicly traded companies like BlackRock and Blackstone, because they have to adjust the value of their assets to the current market value for their quarterly earnings reports. If prices start falling, this hurts their earnings numbers, which has tons of downstream effects on their business. However, the data doesn't fully support this claim that they flee at the first sign of trouble. It absolutely was the case at the beginning of the pandemic, where you can see that investors fled in Q2 2020. Historically, Q2 is a time where investors are quite active. In 2020, that wasn't the case. Their market share went from 17% in Q1 2020 down to 11% in Q2. Investor market share did not fall during the GFC, however, so we need to take this significant rise in investor market share lightly. The main pushback on the argument that we are in a housing bubble and at risk of a residential real estate crash is the fact that underwriting has been significantly better than leading up to the GFC. This is true, and the reason I don't think we're likely to see a large crash until we start seeing massive job losses. I think we are in for a 10 to 20% correction, though, because prices and affordability have just gotten too far ahead of economic fundamentals. Let's take a look at the data, though, because there's a few data points that are interesting. First, adjustable rate mortgages are nowhere near where they were leading up to the GFC. ARMs allow a borrower to pay a much lower interest rate in the first several years of the loan before it resets to a higher rate later on. As prices or interest rates increase and homes become less affordable, it's common for ARM originations to increase as well, particularly in the higher price ranges. In fact, this is exactly what we're starting to see now that prices are sky high and interest rates have started to climb. Slightly more than 10% of applications are for ARMs, which is the highest rate we've seen in more than 12 years. Having said that, ARMs still comprise only 4.7% of total outstanding loans as of the end of March 2022. This is minuscule compared to the roughly 35% share of ARMs just before the Great Financial Crisis. Also, did you know that 75% of jumbo mortgages were ARMs in the 2004-2005 period? Just a little side note, because that's just mind-boggling to me. The second component of underwriting is LTV or CLTV, which stands for loan-to-value and combined loan-to-value. The interesting thing here is that although the current average CLTV on jumbo loans is materially lower than it was leading up to the GFC, CLT of conforming loans, which comprise the overwhelming majority of originations, was actually higher over the 2017 to 2019 period than it was leading up to the GFC. Because of the run-up in prices over the past few years, these loans should have plenty of equity to absorb a moderate fall in real estate prices, provided we don't get a surge in layoffs. In my opinion, that's the dynamic which will determine if we get a housing crash or not. If people keep their incomes flowing at pretty much the same level, they'll be able to absorb some sizable price drops without having to go into foreclosure like they did in the GFC. However, if layoffs surge, all bets are off. Homeowners will choose to sell their property while they still have some equity in it, further increasing the inventory we're already starting to see and driving prices down further than they otherwise would have. The third component of underwriting is the average FICO. There's no doubt that FICOs have improved significantly. The fourth component of underwriting is average DTI. Debt-to-income ratios are just about the same as leading up to the Great Financial Crisis. Notice the large spike in the jumbo loan DTIs, however. That's interesting. The fifth component is the cash-out refis. Cash-out refis aren't nearly as large a portion of total originations as leading up to the GFC, but we have seen a fairly significant increase over the past year or so. We'll have to keep our eye on that. Having said that, according to Black Knight, a mortgage data tracking firm, homeowner equity is at an all-time high and about double what it was leading up to the GFC. Couple that with the fact that leading up to the Great Financial Crisis, homeowners were extracting approximately 16% of their equity at one point. They've only been extracting about 6% over the past several years. This leads most analysts to conclude that the increase in cash-out refis should not be a problem. That wraps up my case that the largest risk to an investment in real estate right now is currently the housing bubble. This doesn't necessarily mean that you shouldn't invest in real estate right now. Of course, if you do and we get a big crash, you'll be underwater for quite some time. But if you can keep a paying tenant in the property and collect the rent checks, eventually the loan paydown and price appreciation will get you back into a positive equity position. Not to mention that if the Fed breaks something with their tightening of financial conditions and eventually has to reverse course and reduce interest rates, we could absolutely see real estate prices take off once again. Whether you wait to see how this plays out or decide that you can withstand being in a negative equity position is up to you. Other risks you face with an investment in physical residential real estate include poor liquidity. If you end up needing cash quickly, it's going to take a minimum of 30 days to sell the property and get the cash in hand. And that's if you're working with an investor that is willing and able to close within 30 days. Most transactions are going to take 60 to 90 days. The best way to address this lack of liquidity in real estate is to have a home equity line of credit open before you need the cash. This way, if you do get in a bind, you can tap that line of credit without having to sell the property. Understand though, there are risks in using these lines of credit. Next is geographic or location risk. Location is so important to an investment in a property that negative changes in the area, whether it be due to poor school performance, higher crime, higher homelessness, or an undesirable business moving into the location, can not only reduce the value of your property, it can also reduce rents and make it harder to rent out in the first place. This reduces your cash flow and therefore the total return on your investment. With real estate being such a large physical asset, it's not like you can just pick it up and move it to a better area. Next are bad tenants. One of the primary reasons of investing in real estate is to generate a monthly cash flow. To achieve this, you have to have a paying tenant in the property. The problem is that a certain percentage of the renter population are just shitty people with little consideration for the well-being of the property or the fact that you may depend on your rent payments. It's also quite common for tenants to ignore small problems that, if they do turn into large, costly problems, will have to be paid for out of your pocket as the property owner. You also may have to evict somebody, which can be very costly and time-consuming. The best way to avoid bad tenants is to have a thorough screening process in place. You can require credit checks, you can require references, primarily their past landlords, and you can require a security deposit. The next risk is vacancy. This is pretty much a certainty when it comes to real estate investing. No matter what you do, there will come a time where nobody's renting your property from you, and unfortunately, this means you're going to have to cover the mortgage payment out of your own pocket. Because this means lost revenue for you, it is vital that you include vacancy in any calculations you do for an investment property. Vacancies can range from 2 to 3% in one area, up to 10 to 15% in another. Talk to an agent, or better yet, a property manager, to get an idea of the vacancy rate in your area. You can also get a high-level estimate by metropolitan area from the U.S. Census website. You can use this estimate in your calculations until you've had a chance to talk to a property manager. The best ways to minimize vacancies is to charge a competitive rent, have a good tenant screening process in place, understand the amenities that are desired by renters in your area, invest only in good locations, maintain a prospective renter, agent, and property manager list, advertise, and keep the property in good shape. The next risk is wear, tear, and major repairs. This is also a fact of life when investing in real estate. There's the normal wear and tear, and then there are the major repairs such as a new roof, busted gas or water pipe, new electrical, etc. that can end up costing you thousands, if not tens of thousands of dollars. The best way to minimize any surprises related to future repair costs is to first set aside at least 10% of your monthly rental income to cover future repairs. 2, stay on top of any repairs needed in the property and take care of them quickly, which will help avoid small problems turning into large costly repairs. And finally, you can buy a home warranty, which is an insurance policy that will help you avoid any nasty surprises over the first couple of years. Keep in mind, however, that this is an additional expense, so it will necessarily reduce your cash flow. And we all know how insurance works. There are going to be several items under every policy that are not covered, so make sure you understand what those are and plan accordingly. Next, we have legal risks. Once you own a property, things can happen on or near your property that can result in you having to pay somebody or risk being sued. For example, somebody can trip on a crack on the sidewalk near your house. If the property is held in your name, your personal assets could be at risk of liquidation or seizure in order to pay for the damages. The best way to avoid this is to hold the property in an LLC or some other legal entity that is separate from yourself. This way, only the assets under the legal entity are at risk and not your personal assets such as your IRA or your savings. Of course, I'm just a dude on the internet with some experience in real estate. I am not an attorney, and all tax-related topics should be discussed with a qualified professional. Next is the risk of asset seizure or a lien being placed on the property. As I mentioned earlier in the video, real estate is a large physical asset that is easily traceable, which makes it more subject to asset seizure or a lien being placed on the property by the state should you do something that they don't like. Now, the probability of something like this happening is quite low, but low is not the same as zero. Next is the risk of negative cash flow. Many of the risks I've already outlined result in a reduction in cash flow, and if you're unable to cover this cash flow deficit out of your own pocket, it could lead to this next risk of investing in real estate, which is default or foreclosure risk. There is a real possibility that some of the risks that I've already mentioned in this video put you in a position where you have to cover some or all of a mortgage payment. If you're unable to do this, it could result in the lender foreclosing on the property, and all of the money and energy you put into the property would be for nothing. To avoid these, take some of the steps I've already outlined in this video to avoid bad tenants, minimize vacancy and repair costs, etc. Additionally, you should carry a larger cash reserve than you otherwise would have. If you normally carry 3 to 4 months of expense in a savings account, you should probably bump that up to a minimum of 6. Next, we have scams or fraud. Just like any other part of life, just pay attention and make sure there's nobody trying to rip you off. This is particularly important for long-distance investors who can't or don't want to go see the property, get a feel for the location, meet the agent, or any other party involved in the purchase. Then there are the large upfront costs. To avoid having to pay mortgage insurance, which increases your monthly payment and decreases your cash flow, you're gonna have to put 20% down. This means you're likely looking at least $20,000 to $30,000, and more likely $40,000 or $50,000 just to invest in a property. There are, however, several ways to finance real estate without putting much more than 3.5% down, although you will pay for this privilege through a higher monthly payment. The best resource I've found for beginners to understand how to finance real estate deals, including 0% down or wrapping renovation costs into the loan, is the book by Bigger Pockets titled Investing in Real Estate with No or Low Money Down. The final risk to a real estate investment is one you directly control: poor due diligence. This applies to any investment, not just real estate. But unless you have significant experience investing in real estate, I strongly suggest that you learn some more before making your first purchase. In fact, you should never stop learning when it comes to real estate because it's such a localized investment. An important employer could leave the area or just freeze hiring. Rent controls can be enacted in the city in which your property is located. You can see increasing crime, decrease in school quality, and much more. All of these could derail your expected returns on a property. Staying on top of such developments could be the difference between generating the returns you originally expected when you made the initial purchase and generating no returns at all or even a loss. To help you with your due diligence, I put together a list of all the resources I use for my residential real estate research. You can find that list by following the link in the description below. Well, that wraps up this video, but this isn't my only content on real estate. If you've ever wondered whether residential real estate is truly an effective inflation hedge or portfolio diversifier, Or perhaps you're new to real estate and would like to learn about the various ways that you can make money investing in properties. You can always take a look at my real estate playlist down here.